Hello, YouTube. Welcome back to the Wolf Catchers channel. So, glad you guys can stop by. So, this video is primarily going to be about stock market fundamentals, right? So, it's kind of going to be like a stock market 101, trying to get from the very foundational steps, right? Because also that's part of what the brand does, kind of what the company does, and what the channel's for, and also like on my website, that's what it's for as well. We're geared to helping, the everyday average investor be confident in the market, be confident enough to make decisions, and also to not second guess yourself. So we're gonna go basically, like I said, stock market 101. Here we go. So again, focus is gonna be to empower you by teaching you essential stock market fundamentals and really gonna emphasize mastering these concepts right before you get into investing, trading if you want to take some more risk. But again, I strongly believe in being an investor first, trader second. But these things and stuff we're gonna go over today, they apply to both types of people, right? Whether you're an investor or a trader, there's lessons in here that can help you out for the long run, right? So fundamentals that we're gonna go through is, empowering yourself with knowledge. Again, you gotta be forever a student, especially when it comes to this. Things are always changing. You don't know what you don't know. So I've heard it be called, and I call it myself now too. People pay the stupid tax. I've done that before too. Get myself into something that I'm not fully aware of what's going on, what I'm doing, and you pay the price for it, right? Either it's going to be with your time, either it's going to be with your money, right? So you want to try to educate yourself as much as you can, but you still have to take action, right? You still got to go in there. You still got to make the trade. You still got to make the investment, whatever it is, right? You got to go in there, but also go in there with as much knowledge as you can, right? And then analyze and research. This is going to be how in depth do you really want to go into this, right? You can be super passive with it, throw your money into a target date fund. Hey, I do $20 every paycheck, $50 every paycheck. I don't care what happens. They say projection said I'm gonna have this amount of money by the age 60, age 65. And that's fine. Some people do it like that. And then there's the extreme where you're you're reading quarterly reports, you're sitting in on earnings calls and things like that, and you're like over indexing or over indulging on the market, right? Me personally, I don't believe I'm being on either side of the extreme. I feel like you should be well rounded, well educated, understanding what's going on, where your money going in terms of investments, what you're invested in, and how to research, right? What are you looking for? Why do you think this? Why do you believe that, right? So again, you don't know what you don't know, right? So you have to go out there, put the work in, do the knowledge, correct? And then staying disciplined. So staying disciplined is whatever you choose to do and whatever guiding principles you have, stick to it. If you have a certain number you want to do per week, per month, stick to it. You have a certain category of stocks or ETFs you like to look at, stick to them. The only way you'll see results is consistency over a long period of time, right? You can't every other week change your strategy, change your investments, pull out of this, pull into that. So it's staying the course, right? So if you get those down packed, you will be a much better investor, and definitely the future you will thank you. So to begin, we're gonna go over market cycles, right? So primarily, there's usually four stages of the market or four phases. So we got accumulation, markup, distribution, and markdown. Or it can be known as stage one, stage two, stage three, and stage four, right? So knowing what stage you're in, right, or what phase you're in, could be a great help to see what's best for you to do at that time, right? So I have a image here up of it, and another person that I came across that does a great job of explaining this and kind of lives by it is Gerald Peters. He's on YouTube. He has a podcast. He's also on Instagram. So he has also like I think like an ebook that he has an image like this in there. But you get this concept, it can help you so much when it comes to your investing, or if you're a trader, to your trader trades, right? So when we look at stage one, that blue area at the very bottom, that's accumulation. So accumulation just means, hey, we got sideways movement here or consolidation. There hasn't been an up run or a rise in prices, right? So this is like a base. Everyone's here accumulating shares. Everyone's here buying shares, right? So when you see that a base being formed and it's a good indicator of something that you're interested in, start building a base there too, right? Start deploying some capital into the trade or into the investment that you like, right? If it's a price you like, and then you're seeing how it looks on the chart. And then stage two is everything starts running up. I know the picture there says best time for buying. Me personally, again, I'm an investor first. So I'm probably going to be buying in the accumulation phase. For traders, they're probably going to be jumping in once they start seeing the breakout. When they start seeing the early signs of that investment or that stock starting to jump out of consolidation or accumulation, that's probably when they're going to enter, right? Because they don't want to sit around waiting. Because accumulation, again, is consolidating. It's just sideways movement. It's going to go up a dollar, down a dollar, up a dollar, down a dollar. Not too much money to be made in that situation. But when it's breaking out, stage two, there's money to be made because it's going to most likely hit higher highs or it's just going to keep running up to a point where it's going to stall out. So that stall out point is stage three, which is on distribution. So it looks just like stage one, but stage three is after stock has run up, after investment has run up, it stalls out or gets tired, it gets exhausted, right? In that stage, people are most likely not bidding the price up anymore. They're probably trimming off a little bit. There's some sideways movement. It's kind of just like, okay, I've had my run. Let me, ease off the brakes a little bit. Then what you're watching for there is this going to break down now, right? So me, usually my rule of thumb is 52-week highs. I like to stay away from all-time highs. I like to stay away from. You could end up in a situation, a series of higher highs and stuff like that. But in the interim, there are going to be pullbacks, right? It can hit an all-time high. The S&P 500 can hit an all-time high, and it could hit it again a month, 2 months from now, break that. But in the interim, it's probably going to sell off for a little bit, right? It's probably going to go down maybe 0.5% or 1%, right? To shake some people out. That's when you get your stage four. Things start going downhill. People are selling, and then again, selling begets more selling. And then you just end up back again to where you're at before, right? The stage one. So after all the selling out, eventually it's going to find a bottom, and it's going to start sideways movement, start building the base again, and the cycle is going to repeat. So you understand those four things right there. It's pretty easy to read a chart. It's pretty easy to read where this might go or what phase this investment or stock is in, right? So then we're going to talk about the indexes, right? So you probably always hear about it, Dow Jones, S&P 500. So we're going to go into what each of these are and some terms, right? But before that, we'll go over what market capitalization is, right? So we have the market cap. And the market cap is essentially what's the value of the company in its entirety, right, on the market. So it's usually the number of shares in circulation times the share price, right, is the market cap. So if I have 10 shares in the public market and they each worth $10, 10 times 10 is 100. So the market cap is $100. That's what it's worth, right? So the companies that we see on the market, they all have a market cap, and that's how they're all valued, right? And then within those market caps, there's tiers, right? We have our large cap, which is usually anything $10 billion or more. We have our mid cap, which is $2 to $10 billion, and we have our small caps, which are less than $2 billion, right? Each of them come with their own quirks. Each of them come with their own personalities and things like that. And it's just about understanding what each one is, right? So Dow Jones. Dow Jones is something that, in my opinion, still very archaic, how it's being treated, how it's being used, but it's something that back in the day, like you probably say 2 or 3 decades ago, carried a lot of weight. Man, even now, then you might still hear people refer to it as like, hey, the Dow Jones is down 500, 600. Back then, it used to mean a lot. Excuse me. Now it's kind of like, yeah, I really don't care what the Dow Jones does, right? It's because it's an index that's just comprised of 30 stocks, right? And they're 30 large cap stocks. And the other issue with it is one, it's just 30 stocks, right? That's not enough broad range understanding or enough information to be like, how's the market doing, right? And then on top of that, it's dollar weighted, right? So how that index is comprised is the share price of the companies. So if you have a company in there that's worth $300 and everything else in there, the other 29 are worth $100 or less. That $300 stock is going to have way more weight in that index. So whatever happens to it, it's going to gear how the index moves, right? And the thing is, it could be a smaller company market cap wise versus all those other companies in there. So which is something that just doesn't make any sense. Like the share, the dollars for the shares determine how big of a position that company has in that index. So some people like to invest in it, some people follow it, this and that. I just put it on there because it is one of the main and key indexes. It has a long history, but it's something that if I see it down maybe 700,000 points, I'll be like, okay, something's really going on. But 200, 300 points, it doesn't really matter because it could be something random that's up like crazy. And then you look into it, it's just like, oh, freaking, what is it? United Health's up. Something random that doesn't really impact the whole market, right? And then we have the baby of them all, which is S&P 500. So this is what people refer to as the market. So when you see the S&P 500, this is the top 500 stocks in the US, and it's large cap stocks, right? So that's everything 10 billion or more, and you also get diversification in here. It's diversified across all 11 sectors, and then it's the best gauge for the stock market, right? So if you see this up, you see it down, or it's going through some turmoil, that's the best gauge to let you really know the pulse of the market, what's going on, how are investors and institutions feeling. S&P down 2-3%. Yo, it's a problem out here. Up 2-3%, euphoria. We're going crazy. Pop a bottle. Like that index itself has so much carries so much weight, right? And then we got the Nasdaq. Nasdaq is comprised of about 3,000 stocks. It's also market cap weighted, and it is tech heavy, right? So with that, it's going to be more volatile, right? So more tech stocks just in nature and just naturally are more volatile, right? So they're more likely to have sporadic moments where they shoot up, shoot down, and the Nasdaq has a lot of those in there. So the Nasdaq itself is way more volatile than the S&P 500. Because remember, the S&P 500 has the diversification across 11 sectors. Nasdaq is really just like, yo, I just got tech stocks. I got some randoms in here, but I'm all tech. So if tech is not doing good, the tech sector, most likely Nasdaq is down, even though it has some stuff in other things like financials, some random things are in there that you're surprised that will be in the index. And then you have the Russell 2000. This one I feel like is usually forgotten about. It's a sleeper. So this is the small cap stock. So in earlier videos, I think with my first one or second one, I mentioned like that little random company that's in Kansas or Idaho you never heard of. It'll probably be inside here, inside the Russell 2000, right? So these are all small cap companies. These are companies that don't usually have a lot of coverage on it. Not a lot of people talk about it. And how the Russell 2000 is kind of comprised. There's nothing in there that's really heavily weighted. So things are like 2%, 3% of the index. So it kind of is a good gauge if that itself is moving, all small caps are moving, right? Because not one or two is going to be enough to move that index, right? When a comparison, the S&P 500, the top three, top two, top three stocks in there, they have a great day. The whole index is going to move, right? So Russell 2000, some people like to have some allocation to it because it usually is overlooked, it's forgotten about, but when it is running, it's running crazy, and then it usually thrives in environments where we have liquidity in the market. We got probably stimulus checks out, or the Fed is printing money. So, and it's cheaper because rates are being cut. It's cheaper to borrow money. Loans are more favorable. So companies like that, because they're small cap companies, they need liquidity. They need money to make investments. They need money to grow their companies. So whenever the Fed is printing money and lowering rates, you'll usually see small caps start to run, right? So building your investment toolkit, right? So these are some pretty important skills for investors, right? You gotta learn how to build a watch list that fits the criteria that you need, right? So know what you're buying, why you're buying it, why is it on your list, why are you interested in even owning it. You're going to create obviously your own thesis, your own uh, vision for it, right? So that's whether it's looking at fundamentals, looking at technicals, um, making yourself be as informed as possible. Why is this on my list? What type of investor are you? And then does this fit the dynamic of what you're trying to achieve? Like I said, when you're a trader, you're trying to trade something in a month, 2 months, or a long term investor, right? If it's on my list, it's something that I feel like is very essential, very important to the economy, or very important to the world, right? Again, when you go to the watch list on the wolfcatchers.com website, you see our monthly updates, right? Some of those names that's on that list, they carry a lot of weight in terms of their importance to the economy, their importance to the world, right? And then some of them are, some high flyers, some random things in there that could become important, right? But a lot of them on there, they're like heavy hitters. They are very vital to what the world needs, right? That's why I feel like if I'm making a watch list, that's how I like to gear it towards, right? But it depends on what you're looking for. And then we got price ranges. I'm a firm believer in not buying at any price. Know what price you like to buy. Me, I use the various amounts of indicators and things like that that I'm comfortable buying at that price. And if it still continues to fall, I'm still comfortable because I bought it at a price I want to. I'm never down or upset like, oh my gosh, I bought it too high because one, I'm not going to buy it too high because I'm waiting for a discount anyways. And it just so happened to fall further than my discount. So you develop that tool set, you develop that framework for you, whether you want to buy in tranches. Like me, I have a 10%, I have some capital, I'll deploy some. Fall some more to the 20% level I like, I'll buy some more. So it depends on what you're doing, right? Some people have 100-day, I'm buying. 200-day moving average, I'm buying. 400-day moving average, I'm selling the house and I'm buying everything, right? So it depends on what strategy and what toolkit you build up for yourself, right? And then we also have the 52-week high, 52-week low, right? Again, as mentioned before, 52-week high, I like to stay away from because that's letting me know, hey, this has been the highest price you've hit in the past year. I don't want to touch you. I'm happy for you. Good job. Keep it moving. I'm waiting till you get on discount, especially if something I want to buy. 52-week low, now you may be more attractive for me to purchase, but you have to know why. You have to know why the stock is down. You have to know why the market is down. You have to know why whatever name you're in or you're liking to get into. Why is it down? Especially when all the signs around it don't make sense. Overall market's up, but this one stock's down 45% of the year, and you're thinking, oh, I found the gold, I found the gem. You probably didn't. If there's 4,000 stocks and 3,999 are up and that one is down, you probably didn't find like the one. You probably should stay away from it, right? Do your research and know why it's down. So building your watch list. This is when I go into fundamentals. Me personally, when I first started all this, didn't have tools like AI, and all these language models that could help you do research. We have them now, but again, you still have to understand. You have to be competent enough to know what to put in there and understand what comes out, right? So me, back when I started my journey in the 2019 to now, I really started on fundamentals in terms of reading income statements, balance sheets, cash flow statements. I've read some annual reports, things like that, and actually broke down the stock, right? Diving into it. I have that section too on the website. Um, how to actually break down a stock and look into it and what you should be looking for and things that should grab your attention, right? So, excuse me. What I have here is a lot of times people are looking at stocks and looking at the metrics or whatever it is. They make the mistake of not comparing it correctly. And so you can't look at like a REIT, which is a real estate investment trust, and compare it to something like Walmart, right? You can't look at a REIT's PE ratio and be like, oh man, it's cheaper than Walmart, so it must be a good deal. No, you have to compare it to its peers, right? So if you're looking to buy Walmart stock, you should compare it to Target. You should compare it to Costco. You should compare what you see on paper for the valuations and all that to a like company, right? Energy should be compared to energy. Tech should be compared to tech. Real estate to real estate, right? Consumer staples to consumer staples. Whatever it is, you should be comparing it to its peer. And if you want to dive even deeper, you could compare it to the S&P 500 because again, that's the best gauge for the whole market. If the things you're looking at, especially if you're looking at valuations like PE ratio, I know these things are probably something you haven't heard of. I have it on the site as well. Something I could make a video about breaking it down. PE ratios, price to book, price to sales, and all those things. When you're comparing to the S&P 500, if it's lower than that, then you probably came across a gem. Maybe you probably got a steal of a price, right? So another thing for fundamentals, this is when we look at the financials, right? Me personally, I like to see growth in revenue year over year. Site you could use is like Yahoo Finance. I recommend that the best because I feel like it's easy to read. Because when you do crack open the 10Qs, which are the annual, no, 10Ks, which are the annual reports, it is, depending on how they present it, it is kind of hard to read, right? I want to recommend it as your first time to go read through something like that. Use Yahoo Finance, click on the financials tab, go through it, try your best to read it. Watch some other YouTube videos of people breaking it down. I could try to make one and put it on there. But yeah, understand the financials behind the company, right? Especially if you're doing individual stocks, you want to pick something that's quality. So growing revenue up, right? Like positive working capital. So that just means they have enough money on hand in a 12-month basis or a year basis to take care of all their debts, right? Take care of all these situations. So that is just current assets minus current liabilities. I want that number to be positive because if something goes left, I know they have enough money there or they have money there to take care of it, period, right? There's a negative working capital, you probably want to stay away from it, right? It's probably not a good sign. And then I like positive free cash flow. Positive free cash flow is just this is just money they have lying around, right? That they could do anything with. Hence the name free cash. So they could put it more into research and development. They could go buy some more stock. They could just sit on it and then next year sit on it again. probably building up a war chest to go buy another company. You like free cash flow because that shows that that company has options and opportunities, right? If it's a negative free cash flow, they are scrambling, they don't have the bread, something's not operating right. And you can't last that long with a negative free cash flow, right? Keep burning candle on both ends, eventually something's gonna gotta give, right? And then technicals, right? So this is more so where I'm into now. Technicals, definitely still do the fundamentals, but I'm more so into the technicals now. After I have my list built strongly of strong candidates on there, right? And these are candidates, like I said, I stick with for years, watch them, this and that. Doesn't mean I'm personally invested in them. I do, like for my son's account, I have certain names in there that I love that are in his account, things like that. And it's based on they have strong fundamentals. And then how I enter them and stuff like that is I'm using technicals, right? The technicals alone, I think, would never be the basis for me to get into a company just because, like, oh, I don't know, Starry is public now on the stock market. I go look at their technicals. I'm not gonna invest in it based on that. I actually want to go look at the fundamentals first. Then the technicals will let me know where is it at in its cycle, right? So some of the technicals are moving averages. There's a simple moving average and then there's an exponential moving average. The only difference is the simple, it's more of a smoother line. It's more of a, it's kind of lagging, right? It takes a couple more candles for it to actually get the price it needs. Exponential is like something happens that day, that hour on the trade, the price is moving, right? The moving average is going to shoot up or shoot down. It reacts more violently to price movement, right? Where the SMA is, it needs a couple more candles or a couple more things to develop before it tells you the whole story. I like that because I like strong confirmation, not knee jerk confirmation or knee jerk reactions to get into a position. And then there's the MACD. That's just a momentum indicator. So it lets you know how strong momentum is in this stock or in this name, right? Or ETF, whatever case may be, to the upside or to the downside, right? Again, I like looking at a higher time frame because higher time frame is showing me strong momentum. It's a good chance that the momentum's still going to keep going, and vice versa, showing strong downward momentum. Probably a good chance it's still going to keep going downward, right? Then if we hit neutral momentum, probably a good spot to be in because you don't know what's going to happen. Then that's where you come into, you start thinking, hey, it's neutral. Start thinking accumulation. Probably going sideways on the chart, right? It's probably consolidating. This probably might be an opportunity, depending on where it just came from its last phase, for me to build a position or start a position, right? Then we got the RSI. I don't know how people feel about it. Me personally, I love the RSI, but it's only an issue if you just trade off of the indicator alone. All this is a problem if you just trust one thing. You need multiple confirmations for multiple things that you're using, right? To give you the best chance of making the right decision, right? I don't believe in looking at one thing and being like, yep, there we go. Time for me to press buy. No. I like to look at multiple things confirming the same thesis, right? Confirming the same idea that I have. So RSI is relative strength index. So usually when this is under 30, it means the stock or the name ETF, whatever it is oversold, right? So that means everybody and their mom is selling this stock. Everybody and their mom is just throwing this off the bridge and I want nothing to do with it, right? Those could be good signs of like this probably is a bottom since everyone is selling, it has to stop at some point, right? But again, you have to know why it's selling. You have to know why this is happening. If something like a pharmaceutical company, you can look at phase three trials didn't go well, or their new drug is not being released. How bad is that for you, right? If that's the company owning bread and butter, it's probably really bad. And it's probably not an opportunity to buy, especially if they had three, four times in a row where they never came to fruition of coming through what they said, right? So those type of things, again, you have to understand why it's doing that. Is the whole market selling off? Cool. That's the whole market having an issue, right? Or just sector having an issue, right? Is like I've been looking at AI. Is AI stocks, AI sector, or the AI industry, whatever you want to call it, going through something? Cool. That's across the board. There's an issue, right? So that's how you look at it. And then the same thing for overbought. So anything over 70 usually means it's overbought. Like euphoria is super high. Everyone's buying it. Your damn dog's buying the stock. That's another caution sign, so red flag to be like, okay, let me not jump into this, right? Let me give it a chance to cool off, see what's going on. You also same thing, vice versa. You want to know why is it running up so much, right? I'm gonna use pharmaceutical again. Trials went well, right? FDA approved something. Stock's gonna skyrocket, right? So, saying another thing could be like cannabis stocks approved across the board. They could use the banks now to store their money, things like that. You could go into a Walmart and buy it now. It's illegal. They're going to skyrocket, right? Their RSI is probably going to be breaking the damn machine, hitting 100. So those type of things, right? Just understand why the stock is moving, how it's moving. So then price ranges, right? So my price ranges, how I personally like to do it. I'm not a big fan of support and resistance. I know a lot of people like doing that, drawing it out. My support and resistance, you can feel free to pause the video and stuff if you want to read all that. But I use accumulation, like stage one, that's my support, right? That's my base. And then I use the stage three as resistance. Like I look for sideways movement down there. Okay, good amount of candles down here. That's support. Falls to this area. Look up to the top. Okay, some good sideways movement over there. That's resistance. We're trading in between this range. That's just how I look at it, right? Everyone likes to do all. I'm not a big fan of line drawing and doing wedges, bullish flags, all these random things people be doing. I just like my moving averages and then seeing what the charts tell me. That's how I like to do it. And then again, from a long-term investor standpoint. I know for traders, there are day traders, stuff like that, that you probably need all those things, right? So again, my price ranges, they usually fall between the 100-day SMA and the 253-day SMA for entries. And when I say entries, this is like buying positions for stocks I like, right? Or companies I like. And this could be on the daily chart and it could be on the weekly chart. Again, I'm a big fan of high time frames. So I would most likely go with the weekly entry than I would with the daily entry, right? Because again, stronger confirmation that this is a deal, stronger confirmation that we are where we are in this stock, in this name. And I do like waiting for 10%, 20% drops from the high, whether that's the 52-week high or the all time high. So I look at it as a sale. With 10% off or 20% off, good buying opportunity, right? And then again with the 52-week lows, they could offer an opportunity, but again, find out why it's so low. Why is it selling off like that? Don't run into every single discount you see or every time you see a sell off. Buy the dip, buy the dip. You gotta be cautious on that end, and you gotta be cautious on the other end when you're chasing stocks, right? And then here's some more strategies to use, especially for newer investors. You got dollar cost averaging. So that's just committing to a certain amount of capital that you want to invest on a consistent basis. That could be weekly, monthly, quarterly, whatever it is, yearly. Top of the year, you dump $1,000 into whatever it is, and then you just do that every year. All of it counts as dollar cost averaging. It's just about doing the same amount over the same amount of time consistently over and over again, right? So that gets you opportunity. You're gonna buy when it's high, you're gonna buy when it's low, buy when it's in the middle, and then the whole thesis is over time, it averages out, right? So you bought some stuff at $10, you bought some stuff at $10. You bought some stuff at 10, bought some at 20, bought some at 15. It's eventually gonna average out, right? To something in between. And it does help with you're not putting too much risk in there. It's just a very good way, like to get into the market, like your 401k. Every time you get paid from your employer, that's dollar cost averaging. Every time you get your paycheck, they took some money out, put it into your 401k. That's dollar cost averaging because you can't choose, when to buy at a high, when to buy at a low. It's just going to deploy the money into your 401k. Then another thing is emotional discipline. So this is, you know, being aware and in tune with your emotions. If you're someone that isn't good with seeing red on the screen, you're not good with seeing your account down 10, 15%, down $1,000, $2,000, 5,000, whatever it is, then maybe reevaluate why you're doing this, and also take a step back. You probably put in too much risk, probably putting too much into it. If it's something like me, I like to look at my accounts. I like to see what's going on. I like to see the market, but I don't look at it as like, oh man, we're down this much and blah blah blah. Like my son's account, he was down about $1,000 in 21 days. But I know what's going on. The market's selling off, this and that. I'm not looking at it as it like, oh my God, what was me? I'm looking at it as like, oh, that was a great opportunity, But you have to figure out what that is for you, right? You have to figure out, are you someone that is FOMO, like you like chase after names? Your buddy said is a hot stock. Are you going to go buy it just because your friend said it? Are you someone that's going to see, oh man, everything's crashing, I'm going to sell right now, because you don't have the patience to buy more or wait it out, right? It only becomes locked in when you press that sell button, right? That's when it really becomes locked in. After that, it's just on paper. So understand your emotional um, discipline, understand how you react with losing money, making money. Try to have a good grasp of all those things, because over time your account's just going to get bigger and bigger, right? You might start off with a couple of dollars, but then it's just going to keep growing and growing. And then those numbers are going to get larger too, whether you're up or down, right? And then portfolio rules, make sure you have rules for your portfolio, whether it's a certain allocation size or a certain amount of money you want to contribute to it, how much cash you want to keep on hand, um, just things like that. Just make your rules, stick hard and fast to it. If you think, hey, I don't want to be too heavy in this section or that section, make sure you stick to it, right? Review your portfolio, make sure the assets that you have in there, there's a reason for them to be there. Has the story changed? And don't be afraid to get rid of something if it's not story changed, right? This is the company that's not doing what I initially bought it for, or the company pivoted to this whole different thing that I don't believe in, right? So again, you're the investor. You're the one that gets to make the choice with your capital, where it goes, and how it works for you, right? So more portfolio management rules. So diversification. Again, I'm big on concentration, but for newer investors, I do believe in diversification, setting a nice base for yourself. Um, and it still allows you to be in the market while you're learning. And then you do that, you're well diversified across the board, whether that's in S&P 500 stocks, you got probably two indexes, working for you in the background while you go learn about individual stocks, while you go learn how to pick quality names and things like that, right? Then you could take some more risk, but you definitely want to be as diversified, because how the quote is going to go is, especially I think Warren Buffett and other people say it too, is like you're diversified because you don't know what you're doing, right? Which is fine, but still let you be in the market. You still get market participation in it, right? You still get the benefit of what the market is doing. You get concentrated when you are sure and you know what you're doing, right? Not saying you're gonna win 100% of the time. Not saying you're a genius, you're a guru, or any of that stuff. But you have a strong foundational understanding of why you put your money into this name, why you accumulated these shares for that company or ETF or whatever it is, right? You yourself have a good foundation, sound mind, and sound reasoning as to why you did this. It wasn't off of a whim. It wasn't because you saw it on TikTok. You know why you're buying it, right? Because most likely the average day person does not know why they buy a stock, does not know why they put in their money into a certain company. They're just doing it most likely because I saw it online, someone told me about it. So you got position sizing. So this goes back to kind of what I said earlier, your tranches, right? Something drops 10%, put some money in. Something drops 20%, put some money in. So you determine how much capital you want to allocate towards this investment, at what prices, things like that. Something like Bitcoin is a great example. I like to mark it off 20% sell off, good time to buy some. 30% sell off, good time to buy some. 50%, you might put your last bit of dollars into it, right? Your last tranche of capital into it. And then back to the regular review. The companies that's in your portfolio have to prove why they're in there, right? So if you got Microsoft, you got Google, then all of a sudden you start hearing them talk about, I don't know, building submarines underwater for underwater navigation with seals and crap. You probably going to sell them because, like, what the hell are you talking about? But if they keep on powering and digging deeper into AI investments, digging deeper into creating better technology, the stuff that they're known for, then it solidifies why you're invested into it. So that's what I mean when the story changes. If Uber gets into, I don't know, something random, something crazy, like park recreation, something out of this world that makes no sense about what the company's based on, built on. If Chipotle starts introducing burgers to their thing, no, it's like, what are you doing? You're playing with my bread at this point, right? So regular review the companies that you're invested in. CEOs coming in and out. Um, Track records of the C-suite, who's coming in and out of there, right? What are they doing to make more money? All those type of things, right? That's why I said it's really important to read those annual reports to see what's going on. And a lot of times too, some of these companies, if you don't want to read through all the pages, they have like a PDF type slideshow that you could go through, and it's pretty simple to go through. They're going to obviously highlight the biggest things and what they're worried about, but that annual report is going to let you know the risk to the business, what they're concerned about, things of that nature. So it's either way how you want to go about it, but definitely look into it, right? You got to review your portfolio and see what's going on. So here I have some example portfolio allocations that I created. It's just some allocations that show different types of investors, right? So I got the all weather portfolio over here. So I got some SCHD, which is dividend ETF, gold and silver. I got VTI, which is the total stock market. That's all 11 sectors, all market cap sizes. And I got QQQ for some tech, right? So that's all weather. Feel like it gives you a little bit of everything. And then I got the aggressive growth. Got Bitcoin in there, QQQ, VUG, which is growth, and the S&P 500. So all those play their part. Bitcoin, I know for newer people, they don't know how to probably use Coinbase, or they want to deal with the trouble of addresses and all that. There are ETFs that do track Bitcoin. One I'm a fan of is FBTC by Fidelity. I personally have capital in that. Um, so that's a way to access Bitcoin without needing to do the hot wallet, cold wallet stuff and storage and all that. You can just buy it via the brokerage, right? So that's an aggressive growth portfolio. Another portfolio is moderate growth. So we got some dividends, SCHD. We got VU, which is the SP 500 for Vanguard, and we got QQQ. Then safe as can be portfolio. This is like for the person who really don't want that much risk, wants to be as safe as possible. We got 10% in bonds. We got VYM, which is a high dividend yield. So it's going to give you some cash in terms of dividends. And you got VT. So VT is the ETF by Vanguard for the whole world stock market, right? So you have the US and every country that does have a stock or stock market um, companies, right? So they're going to be in VT. If it's publicly traded anywhere on the globe, it's going to be in there, right? And then these are our last examples. We got straight dividends if you care about just cash. VNQ, which is Vanguard's real estate. VRIM, again, high yield dividend for Vanguard. And then VIG, which is dividend appreciation. So it's companies that pay dividends but are also increasing their dividend payouts. Then I have Moonshot, which is like, you know, I'm just risking everything, right? So 70% Bitcoin, You got QQQ, and then you got S&P 500, which is sorry. So those are some examples of portfolio allocation. And then just to go back, you can see what kind of pertains to you, right? So all weather is kind of pretty safe. Have some risk to it. You got aggressive growth that's gonna come with some volatility or more volatility than the all weather portfolio, right? Is that something you can do with those drawdowns, just stock dropping that amount, right? Then you got the moderate growth. Hey, I'm a little risky, but I do have something strong like the dividends to hold me back to make sure I'm good. Then you got safe as can be, which is like I am participating in the market growth, but I'm okay not getting the 10% annually. I'm okay getting my 7% annually, you know? And then you have the dividends, who's like, I do not care about market participation. I just want to get dividends and whatever the ETF does, I'm cool with. Then you got the moonshot, who is completely risk on. I don't care what happens. I'm betting everything on this, right? And the thing is, with all these allocations, you can still have them in certain ways, right? You could be predominantly an all-weather person with a small allocation, so like maybe 5% of your portfolio that's targeted towards a moonshot type allocation, right? None of these are set in stone. You build out your portfolio how you want to, what works best for you. But again, over time, you're going to develop and figure out what type of investor you are, what works for you, how you are emotionally when you see your account. Those are the biggest things and telltale signs of like how you should invest, right? So, just to wrap it all up, right? So we went over, mastering the fundamentals, right? Understanding market cycles. So we went and talked about the phases, right? Indexes, because a lot of people don't know what the indices are and don't know because they pop up in your we're gonna say they pop up in your 401k, your retirement plans, just under different names. Excuse me, but a lot of people don't know that. Went over building a well-researched watch list. So again, using the tools that you have at your disposal, they're free. 10Qs, 10Ks are out there. There's tons of people online that are researching stocks. There's a lot of things that have analysts that are reporting on stocks, building their own PDFs. Something I like to use is a Thinkorswim. Type in a ticker symbol. I go to the research tab, and then I got PDFs printouts of like stocks from different companies that's their job. They specialize in researching equities, right? And I see what they say. What do they think? What's the price range they have on it? Why do they think this? Why do they think that? What's the rating they would give the stock, right? So that's just more so doing your research, right? And another thing, the all cost averaging. Even if you're afraid or even though you're second guessing, you could still be putting in something per month in a foundational thing like the S&P 500 or the QQQ while you're learning, right? While you're building the knowledge base and everything. Don't waste 6 months because you're afraid. Put something in there, $10, $15, whatever you could, sacrifice or put in there and go and learn. Because speaking from experience, I spent countless hours learning, watching videos, reading books. I've paid for courses, all those type of things for it to click for me. And then I'm honest with you, probably the last 3 years is when it really like, aha, it clicks. This makes sense to me. I could sit down and watch CNBC and they're up there talking and I completely understand what's going on. I go to CNBC.com, see stuff, I know what's going on. I just get it. So again, I don't have any background from, I didn't go to college for it. I didn't go to school for this or any of those. I wasn't mentored by anyone. It's just I chose to follow certain people, chose to look at their content. I chose to buy certain books, things like that. And then this is where I'm at now. Like it's I'm not gonna say it's easy, but put the time in, put the work in for it, and it's gonna pan out for you, right? You'll be surprised how much you could learn and how knowledgeable you could be in the space. And then maintaining emotional discipline, right, while investing. Don't let your emotions get the best of you. Don't press that sell button because of how you feel. Don't put too much risk. Don't be putting your child's college fund in here because you thought this and that will work out. Don't put the mortgage. Don't trade on margin. those type of things, those knucklehead things. Don't do that. Put in what you're okay with. Like if the stocks were to go to zero tomorrow, would you be okay with the amount of money you put in, right? That's how you have to look at it, right? And then again, regularly review and rebalance your portfolio. Don't let something that's, supposed to be a small position get out of whack. If you have this random company that, it's a moonshot, we'll see if it works out. Then all of a sudden it becomes 80% of your portfolio. You should definitely trim it down back to the 5% you allocated for it, right? Take some of those profits off, roll those profits into something better, right? So just want to again say thank you guys for stopping by. Again, emails right there at thewolfcatcher@yahoo.com. If you have anything you want to send me, ask me a question. You can visit the site. Got blogs on there. Got breakdowns, SWOT analysis of companies, things of that nature. I definitely gotta write some more articles and put up there. It's been, I don't know, it's been like 2 weeks since I put something on there. But my goal is obviously to have timeless information on there for the most part. So definitely check it out, read up, do the knowledge again, brush up on some information. And again, thank you guys for stopping by. Catch and secure your wealth, all right? Have a great one.